Good afternoon, everyone, and welcome to Beacon Pointe's Manager Insights webinar series. My name is Felix Lin, and I head up Beacon Pointe's Institutional Consulting Services Group. Today, our discussion will be a markets and strategy update featuring Mark Hancock and Jonathan Rahbar from FPA. Mark and Jonathan are responsible for research as well as for client service, and would be perfect for us today to just talk a little bit about some of the themes driving today's investment markets. As we've seen, there's been greater volatility in the markets, as well as some heightened news about issues such as trade wars, as an example, and other types of events. And we believe it is timely to have these two gentlemen on our webinar today, and look forward to hearing from them. Most importantly, besides just talking about the market environment, we think it's important for having both of these gentlemen talk about how FPA is navigating these markets on behalf of their clients. Thank you again, all of you, for joining us and for your time. And with that, I'll hand it over to Mark and Jonathan to walk us through their presentation.
Felix, thank you for dialing in and listening to the Beacon Pointe team at large. This is Mark Hancock, and myself and my colleague Jonathan Rahbar will be sort of interspersing as we walk you through a little bit about the world as we see it, and a little bit about sort of with that in backdrop against what we like to do at the fund, sort of recent activity and current positioning, and hopefully give you a good handle on what might have driven recent performance, what might drive future performance, and sort of how, in light of, to Felix's point, current ongoings and undergoings in the world, we're doing or not doing certain things. So I thought we would start with quickly a refresher on what our Crescent Fund attempts to do, because I think it's against that backdrop that it is important to consider what it is that this fund might be doing in terms of new investments, harvesting investments, or sitting on the sidelines in cash. Remember, our goal is to generate equity-like rates of return with less risk over market cycles in the market, and turn to avoid permanent impairments of capital, which is really our definition of risk. The balance of what you can see on the page is repetition to most of you, but we have a very flexible approach. We're not hamstrung by certain geographies, market capitalizations, or capital structures, but we're very much absolute return-oriented investors. So against, on the equity side, what do we love to do? We love to buy compounders, good and greats, where we can buy them really cheaply and hold them for long periods of times. On the what we call live commercial opportunities, are the 3-to-1s, where there's really bad news that we feel is unfairly impacting a specific company or a sector. We like to do that, and then from time to time, they're just what we call special situations that are just independently cheap based on certain factors in the marketplace that we believe are totally idiosyncratic and unexplained. And then obviously, as you know, having been here so a long time, we like to do high yield and distress when we feel that gives us an equity rate of return, of which is not that prevalent in the market. So moving on, performance is performance. We're up about 3% through last night, with at a headline level about 70% invested in securities or risk assets across the market. We're not going to get too much into that, but we'll talk a little bit about drivers and stuff as we proceed. I think as you think about the markets as it is and the role Crescent might play in your clients' portfolios, this is not a fund that is going to perform in line with an index, call it a global or a US index, S&P 500 or the MSCI Equity Index, over short periods of time. Obviously, through a market cycle, if we don't generate those types of returns, you shouldn't own us, because otherwise we've probably proven to be bad at allocating risk assets. And I think the other relevance to own a fund like this, which is a less correlated, defensively postured at times fund, or an alternative aspect to equity-like investing, is to think about sort of the shareholder experience. And Steve Romick, who runs the fund with Mark Landick and Brian Summa, has shown this in the last couple of quarterly webcasts, which is sort of the investor experience. Morningstar does a good job in investor versus fund returns, and the reality is the closer the two are, the greatest shot your clients or investors have at experiencing what the fund's actual historical returns are. And you can see on that page the fact that Crescent has actually generated pretty close from an investor experience, actually slightly higher, but to what the actual fund return is. So I'm looking at investor return versus total return. If you look at the broader indices, simply put, people buy high and sell low. And I think that's an attribute of a fund like Crescent that merits a longer-term holding in a portfolio in the way we described earlier. Talk a little bit about switching to sort of the markets as we see it and sort of what drivers of the market are and maybe why parts of our portfolio performed and parts of other not performed. I know Felix talks about this a lot. This is not our work. This is other people's work. But, we've had of late two sorts of big factors driving the market. We've had for a protracted period of time growth, outperforming value. We're value-oriented investors. And as a result, purely from a growth versus value parity perspective, some of the securities that we own have lagged, others that have more growthier components. We'll get to a little bit more deconstruction of that, in the ensuing slides. But if you look at sort of recent year to date, we've had a very, very strong rally in Goldman Sachs puts as the most heavily shorted stocks. There are two reasons for that. One is we've had sort of the scare of tariffs. So anything with a smaller cap or more insulated revenue stream in the United States is perceived that it's going to do better than anything with a global footprint because of perceived tariffs that could impact, worldwide revenues, and continued access to capital markets on companies that otherwise might not survive, whether it's low interest rates, whether it's strong stock markets, and as importantly, very easy still access to covenant light types of debt. And so if you look at that sort of most heavily shorted part of the index, you can see significant outperformance versus the border index. And obviously, things like that we don't typically own. Moving to the next slide, talk about real deconstruction of what is in the market. None of this will be a surprise. This isn't our work, and there's no genius behind it. But 96% of the market return this year is driven by 6 stocks. We actually randomly happen to own a few of them for very different reasons, and some we've owned for multiple years. Microsoft and Google, to be exact. Microsoft was born in 2009, Google in 2011. We still own them. We don't own Amazon. We don't own Netflix. And we recently bought Facebook on the back of the Cambridge Analytica debacle. And if you take the FANG only. So, if you don't own that part of the market, likely you will lag. And indeed, this year, actually not of recent, but, through half a year, we were slightly flat and the market was up 3 or 4. Global markets or non-US markets are down. But, just sort of deconstructing the market does help. We find advisors think about why one should own different funds at different times. And, if the object is to keep up with the market through shorter periods of time, obviously using Crescent to do that is a wrong tool. A little bit on what I said about growth outperforming value. This slide, page 7, which Beacon Point will have access to, or it's actually all on our webcast, but Felix and Hillary will have this for your usage afterwards. You can see what's sort of driven the market, not much different to what we showed on the previous slide. The next 2 slides are sort of value versus growth, and being the fact that we pride ourselves on hopefully buying great businesses in general at intelligent entry prices, we're not typically growthy type investors. There are definitively portfolio holdings in our fund that look growthy. If you look at Facebook on a headline perspective, it might look a bit growthy. But if you look at how we deconstruct a company like Facebook or a Google, or for that case, a recent addition being Baidu over the last 6 months, there's a huge aspect of that business that can be valued in traditional value metrics, and others which is a lot more sort of optionality that the market is not paying up to in terms of other businesses that we feel could be worth a lot and therefore happy to pay the price we pay. These cycles go for protracted periods of time, sort of green being value outperforming growth and red being growth outperforming value. It doesn't change overnight. And so, being patient and having been here through multiple cycles, this doesn't bother us. It's frustrating that people are paying such hefty premiums for things that might not be valued as we perceive them to be valued, but we're not going to change our investment discipline and how we go about deploying capital against, those companies that we want to buy. But, an interesting chart in terms of, we think, market drivers. Yeah, the stock market is still at reasonable highs and it continues. So against that backdrop, you could consider or could expect a fund like us, who are price takers and disciplined on buying, again, securities cheaply, simply put, that we would be underinvested or finding less to do. And so as the market continues to trudge along at sort of out of headline perspectives, flat to higher levels, so you could expect us to have not a lot to do. But we'll talk about that in a second. Page 11 you've seen before, just regurgitating a little bit about the fact that it's not a target-rich environment for us. Page 12 follows that, just a little bit decomposition on U.S. and global markets. A lot of people have said to us over the last sort of couple of years, well, there's a lot of stuff non-U.S. that's really cheap, and therefore you should be finding things to do. And we've agreed at a headline perspective that perhaps non-U.S. markets are cheaper than U.S. markets, whether it's on the previous positions on the headline metrics or given general indices in different areas. But I think it's important for those who have client money with us to realize that we're not just going to buy a company out of the United States. We're very happy owning a large portfolio of global companies, but we're not just going to stretch because it's cheaper at a headline perspective or any valuation metric. We're quite prescriptive on the types of companies we want to own. So if you think about a global perspective, we like to own companies that are of compounder nature, good and greats and high quality businesses, both here, both the US and non-US. When we get to the non-US types of companies, particularly those that have sort of the commercial or the 3-to-1 aspects of it, we've got to get a really good handle on who these people are allocating the shareholders' capital. Do they have alignments of interest? Is there good corporate governance, etc.? Is there cyclicality? Is there a lot of debt or leverage? So that moves us away from certain types of businesses, a lot of which have gotten cheaper of late over the last few years, not so much the last few months, but why we're probably not having, I don't know, an Indonesian, rubber goods company that's trading at 2 times, earnings because there's probably issues of our own that we don't like. But if you look at it on a like-for-like basis, page 13 talks a little bit about valuations globally. And it's interesting to note that those types of companies, and we just try to pick, across some 10 or 12 industries, some of the great companies in those industries and compared valuations. Some are over, some are under. And so for what we like to buy, again, reinforcing why there's not a huge amount of non-US companies in the portfolio today, they're still fairly valued for what, granted, on the right-hand side, if those international companies were all to drop 20-30% from their current valuation levels, you could be sure that we will be running the ruler really heavily over them, and indeed, in most cases, buying them. So a little color on the geographic composition of the portfolio. The other area we love to nibble on and invest in is high yield or distressed. And I want to talk a little bit about that market as we see it very briefly. Interest rates, have been coming down for a long period of time, maybe having turned up, or certainly shortly in the last year, 100 basis points or so up. But that has often been the fodder of equity, of global strength in global markets. And as interest rates turn, it's definitely a consideration for us to look for potential areas of opportunity, because that might well impact borrowing capabilities and corporate financial constructs in capital structures of companies, which might lead to an area of opportunity. If you look at the high yield market right now on page 15, we read this sort of subtitle there, which is high colon yield. If you take the gross yield on the high yield market in the US and EU, what a lot of people forget is you have historical default rates. It's not every high yielding bond actually makes it to maturity. You have some level of recovery rate. So we just took averages over the last multiple years and net default rate, and we sort of took that off and sort of said, what's your net yield? Well, again, go back to our original mandate, which is equity-like rates of return. You're not going to see us investing in something that's definitively speculative, because otherwise it wouldn't be an high yield, at a targeted rate of return of 4.4, less alone in Europe, and 1.8. It might well change, and we look forward to that because, at least historically, we've been able to capitalize on some of those opportunities. So with that backdrop, just of global markets sort of impacting sort of how we are at 30% cash, which is interesting to know at the beginning of the year, we're probably 37% cash. So why on the back of that have we started to deploy capital against a flat or in some cases upwardly rising market? Well, we're starting to see dispersion in valuation and across sectors and companies for the first time in a long, long time. So utilizing page 16 as a chart for volatility, talk a little bit about sort of just declines and rises as a proxy for what's going on. So while at a headline perspective, I'm just picking today, the market's up, but there were a couple of companies I saw on my screen down 20% today. And that's indicative of what's going on in the world right now, whether it's driven by noise, whether it's driven by concerns about tariffs, whether it's concerns about all sorts of policy aspects. For the first time in a long time, we've actually found some things to do. So the Crescent Fund has made 13 new investments year to date. We've also, on the back of that, probably trimmed or exited 7. But that's a large amount of activity against a flat to slightly rising market backdrop. If the market were down 20%, you could expect us to be doing a lot of activity. And that's the reason cash is down, drawn down by about 7%. It's not all one area we put money to work. It's across industrial complex. We bought 2 cement companies. Across the telecommunications sector, we bought 2 cable companies. We have bought, again, a couple of the more headline internet companies for different reasons. But again, we were afforded the opportunity to buy them based on perceptions in the market that radically hit for a period of time stock price. So, we sit here today, and I'm going to let Jonathan talk a little bit about a couple of investments we made that sort of one wouldn't have expected us to make, or are not Facebook or Amazon or Netflix. But if this continues, it is actually an environment where, for a long period of time, when we walk down the halls of the 11-person investment team and the Crescent Fund, or the Contrarian Valley Strategy, we call it, there's a lot of head scratching going on. There's an enormous amount of research going on, but not a lot to show for it, which causes, simply put, frustration. We're not going to capitulate, but nevertheless frustration. For the first time in a while, there's actually something to show for it. And that, I don't know what that means in terms of this continuing, but it is indicative of a market that is seemingly continuing to be expensive, but yet bifurcating or somewhat idiosyncratic in the opportunity set that it provides for a fund like ours. I'm going to switch to Jonathan Rahbar, who's going to talk a little bit about a couple of investments we made, and then pause and see if there's any further things that we want to touch on.
Sure. Thanks very much, Mark, and thank you very much to Felix and our partners at Beacon Pointe for the time today. So just before I get into a couple of our investments, I quickly want to run through our asset allocation. So right now we're about 74% exposed long to common stocks. We have about 12% of our book in short names. It's worth noting that a number of those are actually in paired trades. As Mark had mentioned, our credit portfolio is relatively low, especially relative to our historical average of about 12%, owing primarily to the fact that yields on junk bonds are frankly just very low. There's not much value in the high yield space, and certainly not much that we've been able to find. So overall, our exposure is about 67% net and about 33% cash. Going on to some of the statistics on our equity portfolio, the couple of things worth noting here are that on a price to earnings basis over the last 12 months, we do look higher than the S&P 500 as well as the MSCI All Country World Index. But going forward, in terms of how we think about the companies that we own prospectively, we are actually about a turn cheaper. And certainly on a price to book basis, where our average price to book is about 1.7 versus the S&P 500's 3.3. Our companies are generally of high quality, cash generative in nature, and so our debt to capital is actually a number that doesn't make sense because our companies are in a net cash position. And the only other thing worth noting here is that our returns on equity are certainly lower than the S&P. Reason for that being is we ultimately are buying companies that are cheap and we expect are able to grow returns on equity. So looking at our portfolio today, I just want to touch quickly on a couple of names. During the second quarter of 2018, we added to our position in Arconic, as you will see in the industrial sector. Arconic's an aerospace value-add manufacturer that was spun out of Alcoa in late 2016. So Arconic was widely considered the good business within Alcoa, but frankly, it was mismanaged and spent a good amount of time post-spin in an uneconomical proxy contest to protect what was their failed CEO as well as a defective board. And after the reluctant surrender to shareholder demand, Arconic spent 2017 with basically a caretaker CEO at the helm. The reconfigured board selected a new CEO in Chip Blankenship, who joined in 2018 and previously headed General Electric's appliances business. Now, the business overall underperforms peers from a margin perspective by anywhere from between 300 to 1,000 basis points, which is frankly not particularly surprising given its history of poor management and governance. In the second quarter, reduced guidance for 2018 combined with some of the trade concerns that Mark mentioned caused a decline that gave us an opportunity to increase our position at prices that we believe discounts the possibility of the company improving its operating performance. We believe the company's competitive position and market opportunity remain intact, and while operational improvements certainly will take time, the combination of that leading market position and a capable management team leave us optimistic that Arconic will ultimately achieve its operating potential. The other name that I quickly wanted to touch on is AIG, the once beleaguered insurer if you were to go back about a decade now. AIG represents about 3.1% of assets as of the second quarter's end. We were buying shares of AIG that at prices representing roughly 80% of tangible book value and roughly 11 times estimated 2018 earnings. We believe the shares represent good value based on current operations. And just to be clear, the company installed a new management in mid-2017. So Brian Duperall came to AIG in mid-2017. Before that, he led Marsh, and we ultimately knew his performance there following Marsh and for a number of years. And prior to that was actually the chairman and CEO of ACE for about 2 decades after having started his career in the insurance industry circa 1972-73. So we're hopeful that new management will ultimately meaningfully improve the company's returns on equity, and we remain holders of AIG's company stock. With that said, I'll go ahead and turn it back over to Felix and the Beacon Point team for any closing comments. Thank you all very much for the time.
Great. Thank you again, guys, for your thoughts on the market, and definitely think this was helpful for all of us in understanding what factors are driving the current market environment, as well as a better understanding of FPA's strategy. So thank you to all of our clients listening in. We appreciate your time and the relationship we have with you. Please do not hesitate to reach out to us if you have any additional questions on the market or on FPA's investment strategy. We can be more than happy to review that in greater detail with you or connect you with the 2 gentlemen on the call today. And in addition, you can send questions to bpawebinar@beaconpoint.com, and we will answer and address any questions you have as soon as possible. Thank you again for your time, and we hope you can join us for our next Manager Insights webinar. Have a great day.